Bill Ackman just launched an attack on Herbalife by selling short of $1 billion of the company's stocks, betting on its ultimate demise.
All pyramid schemes will ultimately collapse. The only people who make money are those few who are at the top of the pyramid.
See, there's Herbalife stock down 14.6%.
This is not the first time Ackman attacked a company in a public way. He represents the activist investors, ones with ruthless ambition to battle corporate America and to make billions.
Phineas.
From an early age, Ackman shows a strong entrepreneurial streak, running a cart waxing business to make his own money. Ackman was always a confident and ambitious young man. Some even consider him to be arrogant. It has to do with the fact that he was born in a very wealthy family. Beginning in the early 1920s, Ackman's grandfather built a thriving real estate business. By the time Ackman was born, his father Larry Ackman has taken the family's business to a higher level, making millions of dollars a year.
I certainly live in a home where you learn never to give up on pretty much anything. Mom and dad, hardworking, motivated, educated people, high ambitions for their kids, always talked about setting an example. I learned a lot of things from my parents.
After earning a near-perfect SAT score, Ackman is accepted to Harvard. Like all young men growing up in a successful family, Ackman's father expects his children to one day take over the company. After graduation, Ackman spent 2 years working for his dad. But deep down, he wants to create his own business empire, one that will trump his father's. The problem is, he doesn't know what business to start until he meets the most prominent investor in America. Warren Buffett is the most celebrated investor in the world. In his long career, he turned a near-bankrupt company, Berkshire Hathaway, into a $700 billion behemoth. With the help of his family's connections, Bill Ackman gets to meet Warren Buffett in person.
I do think Buffett is the greatest investor, and the reason why I believe that is, this is a 50-odd year, it's a 60-year track record of compounding at 20+% with a very modest amount of leverage, in the form of principally insurance float, and I just don't think there's a record that compares.
Ackman has found his true calling, becoming the next Warren Buffett. The 1990s was a turbulent decade. After suffering a recession from the Black Monday crash, the US economy was slow to recover. But the stagnation gave rise to a thriving industry, the hedge funds. Operated by opportunistic investors, hedge funds made profits when others couldn't. Inspired by Warren Buffett, Bill Ackman is ready to build his own Berkshire Hathaway. Using his $40,000 savings, he starts looking for his first big idea. It will come from an unusual place.
I have an old-fashioned belief that I should expect to make money in things that I understand. And when I say understand, I don't mean understand, what the product does or anything like that. I mean, understand what the economics of the business are likely to look like 10 years from now or 20 years from now.
One of Ackman's first investments came from an area where he understands better than most people: real estate. Alexander's is a real estate investment trust that owns many retail department stores in New York. After Donald Trump took a 20% stake in the company, it started losing money.
Alexander's and its well-known mural have been fixtures on Route 4 in Paramus for 30 years, but some say the lone department store no longer could keep up.
By 1992, the prospect of bankruptcy was looming. Its shares were trading at $8 each. Ackman knows the company is worth much more. He realized that even if the company goes under and their properties get sold in the market, they will still be worth a lot. ACKMAN bought stocks of the company at a bottom price. The investment was a success. After the company emerged from bankruptcy, the stock price started to shoot up. ACKMAN sold it for $21 a share, almost tripling his original investment. After beating the market multiple times, ACKMAN is ready to start his own hedge fund.
And then I was doing this alone in my dorm room. And I recruited a classmate, a guy named David Berkowitz, to be part of this two-person, it wasn't even an investment club at the time at business school. And we had fun kind of looking at ideas together. And I said, look, imagine if we could do this and people would pay us to do this. And that was the genesis for starting a hedge fund, which I did in 1992 called Gotham Partners.
Leveraging his wealthy network, ACKMAN raised $3.2 million for his hedge fund. Gotham Partners started aggressively investing in undervalued stocks, generating 20% return in his first year. Bill Ackman then used that track record to raise another $10 million for his fund. We can see that from the very beginning, ACKMAN was very talented at rallying people for their support, whether it is raising money or getting shareholders' votes. Looking at his mentor for inspiration, ACKMAN realized he could be an activist investor, like the early days of Warren Buffett.
And Buffett started out managing really an activist hedge fund. If you follow him from the mid-1950s to the late 1960s, he managed what best described as an activist hedge fund.
There's a reason why activism makes sense in certain cases. At some companies, the managers kind of forget who they're really working for, and it becomes their own playpen. And at others, managements are sometimes incompetent. We're not saying often. And it's the job of a board when that occurs to do something about it, and sometimes they don't.
To become an activist investor, ACKMAN would take a large position in a company to advocate change in order to raise the stock price. It doesn't take long until an investment opportunity shows up. Sitting at the heart of New York, the iconic Rockefeller Center is a large complex consisting of 19 commercial buildings covering 22 acres. But by early 90s, the real estate market fell apart.
And in 1990, the whole country, it just went very, very bad.
The stock price of Rockefeller properties collapsed, and the REIT was under a lot of financial stress due to its high debt. While the company is going through bankruptcy, ACKMAN purchases as many shares as he can. As an expert in real estate, ACKMAN knows the REIT is being significantly undervalued. He partnered up with the business magnate Joseph Steinberg. Together, they purchased 7% of the company and start an attempt to take over. ACKMAN's takeover attempt draws a lot of attention from real estate tycoons like Sam Zell and even David Rockefeller himself. But ACKMAN was outbidded. By forming a partnership with Goldman Sachs, David Rockefeller amassed control of the real estate trust. Although ACKMAN didn't win control in the end, his investment paid off. The Rockefeller play helped Gotham finish 1995 with a 39% return. Everyone was so blown away by this young man who was barely in his 30s. Although he didn't take over the company, he earned the respect of the Wall Street heavyweights, and they became his investors. By the late 1990s, the hedge funds boomed, attracting thousands of ambitious young men to the industry. Bill Ackman grew up in a successful family, but defying his birthright, ACKMAN wants to build his own business empire. By age 30, ACKMAN's hedge fund Gotham Partners quickly grew to worth $500 million. He is now the master of the universe, but he's too blinded by success to see his downfall. Gotham Golf is a real estate group that controlled 24 golf courses around the country. ACKMAN invested heavily in Gotham Golf, believing that his properties would keep surging in value. He was wrong, as the real estate value kept declining. Instead of cutting losses, ACKMAN doubles down. Like Buffett and Munger, if he sees an undervalued asset, he makes a very large and concentrated bet
Diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses.
But ACKMAN fails to realize that his hedge fund is not Berkshire Hathaway. Buffett and Munger can do really long-term and concentrated investment. That is because their company is not set up as hedge fund.
One of the great advantages that Warren Buffett has is he manages a public company, doesn't have to worry about investors redeeming their capital. The problem with hedge funds is that your money can leave typically every quarter. And it's hard to be a long-term investor when your investors can take their money back.
When ACKMAN keeps losing money with Gotham Golf, his investors want out. Not willing to liquidate his positions, ACKMAN tries to raise more money. But when that is not nearly enough, ACKMAN is forced to come up with a more creative way to save his fund.
Are you happy with your job? You're looking to raise your standards, raise the quality of your lifestyle, then Prepaid Legal Services is an incredible vehicle.
ACKMAN's solution comes from a bizarre company. Prepaid Legal Service was a multi-level marketing company that sold legal services. Today it was known as a legal shield. The company was heavily shorted on Wall Street, with skeptics charging that prepaid service was actually a worthless pyramid scheme. But ACKMAN believed the company was undervalued and built a large position in the company. But the stock price was slow to move up, and ACKMAN lost his patience. To pop up the share price, ACKMAN released a public letter on his website, boasting how great the company is. It worked. The stock price started to rise, giving ACKMAN some breathing room. But his headache is far from over. Driven by subprime loans, early 2000 was the start of a real estate boom. ACKMAN saw a rising level of financial scams and frauds, indicating a financial bubble is brewing. After investigating a financial company, NBIA, ACKMAN bet the company to fail using credit default swaps. Although his investment thesis on NBIA turned out to be correct, his timing was wrong. NBIA sued ACKMAN for market manipulation over his prepaid legal service investment. Legal trouble caused more of his investors to flee. Desperate, ACKMAN decides to make a deal with the most dangerous man on Wall Street. His name is Carl Icahn. Carl Icahn is a notorious corporate raider. Grew up poor in Bayside, Queens, Carl Icahn joined the booming stock market in the 1960s. Through decades of corporate battles, Carl Icahn became the undisputed king of takeovers.
I own it. It's my money. I worry about the bottom line because if I lose, I'm answerable to my bank account.
Carl Icahn was a really tough guy to work with. To make a deal with Icahn, it goes to show how desperate Bill Ackman really was. As more investors want their money back, Ackman is forced to liquidate his stocks, even the ones that have huge potential. Hotwood Realty was another REIT whose shares were trading at $60, but he thinks the company is worth $140, and it would be a bad idea to dump his holdings in the market. He called up Carl Icahn. Icahn sees the company to be undervalued as well, and is willing to buy Ackman shares at $80, $20 more than the market price. Carl Icahn has been investing much longer than Bill Ackman. He knows a bargain when he sees it. He also knows that this company is perfect for a hostile takeover. After acquiring the shares from Ackman, Carl Icahn immediately starts a proxy fight to gain control over the company. The management at Hotwood Realty fears what Icahn would do to them if he wins control. Instead, they found a white knight to buy the company. Carl Icahn shares were acquired for $137, making a stunning 72% profit. Carl Icahn really lived up to his reputation. Win or lose, he always makes more money. But now, Ackman wants a piece of that profit. What Carl Icahn failed to realize, Ackman added a clause in their original agreement. that if Icahn makes a profit out of Holtwood over 10%, ACKMAN is entitled to half of it. Carl Icahn has built a career out of fear and intimidation. He refuses to pay ACKMAN and threatens to sue him. But ACKMAN is not easily scared. He sues Icahn back. In the end, the court favored ACKMAN and ordered Carl Icahn to pay him $9 million.
When you're talking about people at the top, their competitiveness is rooted in ego.
To billionaire Carl Icahn, $9 million may seem like a pocket change. But if there is one thing Icahn hates the most, it is losing. And he will get his revenge. What ACKMAN failed to learn from Buffett is the rule of never lose your money.
Rule number 1, never lose money. Rule number 2, never forget rule number 1.
The last 2 years have been one of the most unusual times in financial history. To protect your money, one must find alternative investments that are uncorrelated to the market. One such a market is art. After all, the ultra-wealthy people like the hedge fund billionaires I cover put a lot of their personal money in arts. From 1995, investing in top contemporary arts have outpaced S&P 500 by 174%, which is 14% per year on average. Masterworks.io, the newest $1 billion startup, makes it possible for people to invest in multi-million-dollar paintings at a fraction of the price. It acquires art ranging from $1 to $20 million in value and securitizes it through the SEC. On their platform, anyone can invest in those paintings via fractionalized shares, just like buying shares in a company. And when it comes to returns, they were best in class, returning 32% net of fees to their investors from the sale of their Banksy painting. As a special bonus, I'm giving you priority access to invest in this asset class that outpaces gold, real estate, and stocks. Their platform typically has a wait list, but if you use the unique link in the description, you can skip that wait list and have access to their current offerings today. After the collapse of Gotham Partners, ACKMAN is wasting no time launching his new fund. He raised $50 million to start pushing Square Capital Management. ACKMAN now only focuses on activist investing in more liquid public companies.
Normally we look for a great business that had lost its way. We try to figure out what they had done wrong, and then we recommend a series of changes after buying a stake in the company. That's sort of our core business.
The essence of ACKMAN's strategy is the same. He looks for companies with a lot of real estate because they're more tangible and have more predictable cash flows. And not surprisingly, he buys a lot of restaurants and retail stores.
Wendy's didn't start the chicken wars. They just ended them.
In July 2005, Pershing Square took a 9.9% stake in Wendy's. He then launched a campaign to get the company to spin off the Tim Hortons donut chain. Just a few weeks afterwards, Wendy's agreed to spin off. The news caused the company share price to rise to $50 when ACKMAN bought them barely at $30. ACKMAN is very loud and public about his investment. It works because this Wendy's success got him a lot of investors. With this one trade, he pretty much resurrected himself. After Wendy's investment, ACKMAN made another 100% profits with McDonald's. By 2010, ACKMAN's Pershing Square has become a rising star on Wall Street with $10 billion assets under management. His concentrated investment approach seems to have worked.
I think what's unusual about us is we're very concentrated. We own 10 investments. A lot of people talk about being concentrated. They might have 30, 40, 50 investments. Their top 5 are big, but we literally own 10 things.
ACKMAN may be right, but he fails to see his investment style will soon get him in trouble again.
He is the largest shareholder in JCP with a whopping 18%. In the past, he lost $32 million in after hours on the stock reactions to Ron Johnson's moving out.
JCPenney is a declining department store chain with 689 locations in the United States. After taking an almost $1 billion stake in the company, ACKMAN fired the CEO and hired a new one from Apple, Ron Johnson. Johnson went on to implement many drastic changes that turned out to be disastrous.
Hedge fund manager and activist shareholder William Ackman resigns from the board of JCPenney after a lengthy period in which he forced his own disruptive shakeups on the companies.
Ackman lost half of his investment in JCPenney. To reverse his fortune, Ackman is again desperately trying to find the next big idea.
If you follow what I say, write this down, you're going to make a minimum of $50,000 this year. That's the least amount of money that you're going to make. The second year, you'll make $125,000, and that's the least amount of money that you're going to make.
Mark Randall Hughes started Herbalife at the age of 24 out of the back of his car. Over the next 20 years, Hughes builds Herbalife to a business powerhouse with $1.8 billion sales a year. But then, at the height of his career, he dies from drug overdose. At the time, Herbalife had a very sketchy sales practice. With the death of the founder, they're looking for a new CEO. And they're also looking to rebrand themselves to look more legitimate. Then they found the perfect man for the job. Before Herbalife, Mike Johnson was an acclaimed marketing executive. During his 17 years working for Disney, he brought in over $1 billion in revenue for his department. With Johnson in charge, Herbalife started to rebrand itself to be more legitimate.
I don't think the Herbalife today is the Herbalife of what it was years ago. And I know that Michael Johnson has tried to clean up the business a bit so that it's not entirely based on recruiting.
To make up for his JCPenney blunder, Bill Ackman needs to find his next big investment.
In the case of Herbalife, I'm not a shareholder pushing to make a business more valuable. I'm an investor who's made a bet that the business will fail. We're short the stock, and what we are doing is we believe that Herbalife is operating a pyramid scheme. We believe they're transferring wealth from a very large number of low-income, principally Hispanic individuals in this country and around the globe to a handful of wealthy people.
Knowing Bill Ackman, he's not going to do it in a quiet way. He will publicly execute the company.
40 to 50% of the revenues of the company come from a business method called a nutrition club, which itself is entirely fraudulent. They've got fake customers. These are not customers. These are people who are buying into a mini pyramid scheme. All right? There's nothing circumstantial about it. We have facts.
Our CFO called Mr. Ackman this morning and asked him to participate. Mr. Ackman said no, and he refused. Now we know what this has been going on for in the shadows, as we say, for the last 8 months. This has been ridiculous what's happening here. We're not a pyramid scheme. That's a bogus accusation.
Herbalife immediately starts a public campaign to fight back, but it does little to boost the shattered confidence of investors, driving its stock price to a new 52-week low. Just when all hope is lost, Mike Johnson gets an unexpected visit from another hedge fund manager. His name is Dan Loeb. Dan Loeb, an opportunistic capitalist, made his fortune as an activist investor like Ackman. Today, his hedge fund, Third Point, has $15 billion assets under management. Loeb was also a famous short seller, but he sees Herbalife as an opportunity to profit by triggering a short squeeze.
Loeb is of the same, generational age as Ackman. Another sort of smart and handsome guy who gets a lot of press, and for good reasons. His performance has been fantastic. He runs Third Point LLC. He emerges. He comes out of the blue with a big position long Herbalife, so he was in favor of Herbalife. And that really shook Ackman.
Dan Loeb used to be Ackman's friend. Now he's trying to screw him over. It goes to show that there are no real friends on Wall Street. The betrayal of Loeb cost Ackman tens of millions. But this is just a start. Ackman's Herbalife short makes him vulnerable, and his enemy knows it. Through years of boardroom battles, Carl Icahn has garnered an astonishing fortune. By 2014, Carl Icahn was worth $25 billion. Carl Icahn doesn't answer to anyone. He trades his own money. He can go the distance to force his opponent into submission. After losing $9 million to ACKMAN in 2010, Icahn has been waiting for an opportunity to hurt him back. He sees Herbalife short as the perfect opportunity to enact revenge on Bill Ackman. Wasting no time, Icahn starts building a large position on Herbalife.
I think Herbalife is a great company. It makes great products.
With the support of Mike Johnson, Icahn acquired 2 seats at Herbalife's board. They then bring on the former U.S. Surgeon General Dr. Richard Carmona to the board, further strengthening the company's legitimacy. The share price soared 100% as a result. To Ackman, this is nothing short of a declaration of war.
And I'm telling you, he's like the crybaby in the schoolyard. You know, I went to a tough school in Queens, and they used to beat up the little Jewish boys, and he was like one of these little Jewish boys crying that the world was taking advantage of him.
Bill Ackman was underestimated before. He's not going down without a fight. Ackman's first defense was to replace half his short positions with put options.
Put option is nothing more than an insurance contract on the value of a stock.
At the same time, Bill Ackman doubles down on his effort to lobby the government to shut down Herbalife. FTC and FBI opened an investigation on Herbalife, which slashed the company's stock price by 14%. But in a shocking turn, FTC didn't find Herbalife to be a pyramid scheme.
It's a case of good news, bad news for embattled company Herbalife. The Federal Trade Commission will not classify it as a pyramid scheme, but in return, Herbalife will pay a settlement of $200 million.
It is time for Ackman to wind down his positions. But then he receives a phone call for none other than his nemesis, Carl Icahn. After the FTC verdict, Carl Icahn was looking to exit his positions at Herbalife, but he can't just dump his shares in the market, which will cause a panic. He's looking to sell half of his shares to someone who's willing to buy, and that someone is Bill Ackman. But that was a mistake. Bill Ackman used this chance to get revenge on Icahn for what he did to him. He leaks the information to the press, immediately causing a panic in the market.
The battle of the Wall Street billionaires gets another twist. Carl Icahn recently discussed selling his whole stake in nutritional foods company Herbalife to his arch nemesis William Ackman, among others.
To calm the market, Carl Icahn was forced to buy more Herbalife. Once again, 2 billionaires are at a standstill. But to Bill Ackman, Herbalife is the least of his concern for now. His real trouble has just begun. By the 21st century, with the emergence of large ETFs, American companies have become complacent, as their biggest shareholders tend to be passive funds. This gives rise to the activist hedge funds who rally those colossal ETFs to be more active. Leading the charge is Bill Ackman, who through his high-profile campaigns has changed the way many companies operate. In doing so, he's made billions. After shorting Herbalife, he found himself locked in a battle with the most formidable investor on Wall Street, Carl Icahn. The emergence of Icahn cost Ackman hundreds of millions. While the Herbalife battles continues on, Ackman finds himself in another fight. Except this time, it may be the end of him.
Valiant's forebear, or kind of its origin, was a company called BioVille, which is a corporate clogged toilet based in Canada.
We've got a merger in the medicine business.
In 2010, there was a sort of a merger of equals with Valiant Pharmaceutical.
Valiant planted a foreign flag to save money as a way to skip paying taxes stateside.
And a guy named Mike Pearson took over the remaining company.
Our job is to create shareholder value. And so people shouldn't be afraid of anything that happens that helps them create shareholder value. That's our job.
Bill Ackman believes Valiant to be the next Berkshire Hathaway. Its growth strategy is not driven by new products, but by acquiring other companies. Except Warren Buffett's Berkshire Hathaway is not a pharmaceutical company. It is an insurance company whose business model is about collecting people's money based on future promises.
I mean, this is a company that buys drugs
As we know, it hikes prices, even though they claim that's not a big part of their strategy. We believe it is. I think that whole model of not spending on R&D and purchasing drugs gave the company a pass that now they're maybe not getting.
Pharmacy facing a backlash from accusations about its relationship with high-flying drug maker Valiant Pharmaceuticals shutting its doors, closing. Philidor is the name. It announced, you know what? We have to wind down our principal operations. Done, closed, goodbye.
ACKMAN's world is tumbling down.
Why would you not recommend to the board that, over a 30% increase for 1 year? I would think that's a pretty good return rate. Why don't you charge $3,000 for that?
Look, it's something we'll discuss tomorrow.
You will discuss dropping the price of Isapril to $3,000 because that's over a 30% increase in the original price.
So we will absolutely discuss it.
Okay.
The failure of Valiant is a devastating blow to Bill Ackman. To make matters worse, Herbalife stocks stabilized and are slowly recovering. Ackman's Pershing Square starts facing redemptions again.
Always had the view that how successful you are is really a function of how you deal with failure. And if you deal with failure well and you persist, you have a high probability of being successful. So I've always kind of had that view. And then I've had to apply it to myself, certainly a few times. And I always like to say that experience is making mistakes and learning from them. And I've had the benefit of having made a lot of mistakes.
Ackman learned from his previous hedge fund that redemptions can be very scary. That's why he went public in London Exchange. This time, he's not going down. By 2019, after breaking even for nearly 3 years, his fund made 57% return. Ackman's Pershing Square is making a comeback. But his resurgence will be challenged by the most unexpected crisis of mankind. Ackman has learned from his past mistakes that one should always have insurance against the worst-case scenario. By the beginning of March 2020, Ackman placed a hedge using credit default swaps. Then he went on TV to warn the public.
Hell is coming, okay? And I felt, it's really, I've never had this experience before in my life. The closest I had was the financial crisis where I'm saying, things are coming, bad stuff's coming. But this was a feeling like I've never had. Like there's a tsunami coming, right? The tsunami's coming and you feel it in the air.
As COVID gets worse in America, the market begins to fall.
And all this has rocked financial markets around the world, the worst sell-off on Wall Street since the financial crisis in 2008.
In a few months' time, Ackman's hedge generated over $2 billion profit. After closing the short positions on Herbalife, Ackman has decided to never go short on another company.
We're generally long only in terms of we own things, we don't short stocks. We did a couple times famously in the past, but not going forward.
He has gone back to his circle of competence, companies with large real estate presence. At the same time, Carl Icahn has exited his positions with Herbalife, ending a decade-long beef with Ackman.